Imagine that somewhere beneath the noise of daily headlines, beneath the latest jobs report and the latest market move, there is a slow, deep current running through the world economy, a wave so long that you do not feel it in a single year or even in a single business cycle, but over your entire working life. In this story, prosperity, crisis, war, and reset do not arrive randomly. They come in a 4-act sequence on a schedule that averages about half a century. First is the long boom, when technology and credit pull everything upward. Then comes a grinding disinflation or deflation, when debt becomes heavy and growth feels harder. Out of that tension, according to the theory, come large-scale conflicts and social upheavals. And when the smoke clears, the winners of those conflicts sit down to rewrite the rules of money and trade, resetting the system for the next wave. That is the myth of the Kondratiev wave, the so-called 50-year super cycle. Today, in 2025, a lot of people online talk as if this wave is an iron law. They place vertical lines on charts, call each one spring, summer, autumn, winter, and declare that we are standing at the edge of the next great collapse. But how much of that is real pattern and how much is hindsight storytelling? In this video, I want to do something slightly uncomfortable for both fans and critics of the idea. We are going to take the Kondratiev story seriously enough to tell it well. We will walk through roughly 200 years of economic history as if this 4-phase wave is real. Boom, disinflation, war, reset. We will see how nicely we can make the last 2 centuries fit into that script. Then we are going to turn around and do something colder. We will look at actual data, prices, interest rates, wages. We will look at what historians and statisticians have tried to do to test for long cycles. And we will see where the story lines up with reality and where it completely falls apart. Only after that will we come back to 2025 and ask the question everyone actually cares about. If there is any truth in this idea at all, where might we be on the wave right now? Are we closer to a peak, a trough, or somewhere in the long in-between? And what does that mean, not for grand theories, but for something more personal, your career decisions, and how you think about your financial life over the next decade? To start, we need to meet the person whose name this whole thing comes from. In the early 1920s, a young Russian economist named Nikolai Kondratiev was sitting in archives poring over price and interest rate data from Britain, France, and the United States. Russia had just gone through revolution and civil war. Around him, Marxists were arguing that capitalism was entering its final crisis and would simply collapse. Kondratiev saw something different. When he charted wholesale prices, interest rates, and other series going back into the 19th century, he thought he could see long waves running roughly 40 to 60 years from trough to trough. In his view, capitalist economies did not just bounce randomly between boom and bust in short business cycles. They also seemed to pass through these longer periods of strong expansion, rising prices, and low rates, followed by periods of slower growth, falling or flat prices, and higher real interest rates. By the mid-1920s, Kondratiev had published these ideas in works with titles like The Major Economic Cycles and The Long Waves in Economic Life. Western economists took notice. The Austrian-American thinker Joseph Schumpeter later popularized the term Kondratiev waves and linked them to clusters of major technologies, steam and textiles, railways and steel, electricity and chemicals, autos and oil, and so on. Over time, fans of the idea added more structure. They gave the waves season names. The early upswing, when a new technology spreads and investment surges, became spring. The mature boom, when everyone piles in and capacity overshoots, became summer. The disinflationary, debt-heavy stagnation that follows became autumn. And the cold, crisis-ridden, often war-filled final phase became winter, the part of the cycle that ends with some kind of reset to money and institutions. It makes for an elegant story. But even from the beginning, this was controversial. Modern summaries of the research are pretty blunt. Long wave theory is not accepted by most academic economists. Even among those who find it suggestive, there is no agreement on what causes the waves or even on precise start and end dates. Critics argue that many of the patterns people see here are examples of apophenia, the human tendency to see structure in random noise. That makes this a perfect candidate for what we are trying to do. Treat it as a hypothesis, not a prophecy, and see how far it really gets us. So let us lean into the story first. Imagine zooming out on the graph of the modern world economy from the early 1800s to today. Instead of the jagged line of quarterly GDP and market cycles, you smooth it into big arcs that last about half a century each. Proponents of the Kondratiev wave often sketch something like this. The first wave in their story usually starts in the late 18th or very early 19th century with the early Industrial Revolution in Britain. Steam engines, mechanized textile mills, ironworks, canals. All of these break the old agrarian constraints on production. You get decades of rising output, urbanization, and new fortunes. Prices, especially for industrial goods and labour, tend to rise in this phase, while borrowing costs are relatively low. Then, according to the theory, the wave crests. After the defeat of Napoleon around 1815, Britain and much of Europe shift from war mobilization to peace. Politically, you get the Congress of Vienna, a reset of borders and rules. Economically, you get something that really does fit part of Kondratiev's idea. A long stretch where prices are flat or falling. If you look at the British Retail Price Index, reconstructed by the United Kingdom's Office for National Statistics all the way back to 1800, you see a clear pattern. Prices surge during the wartime years leading up to 1813, then fall almost continuously through the late 18-teens and early 1820s. From about 1820 into the 1840s, the general price level in Britain drifts gently downward even as industrial output and trade expand. That is one of the historical anchors for the disinflation or deflation phase of a Kondratiev wave. You have real economic change still happening, but debt becomes heavier as prices soften, and farmers and small producers feel squeezed even while urban industry marches on. You also get periodic political shocks. The revolutions of 1830 in France, for example, and social unrest across industrializing Europe. Proponents stretch this phase into the wave's winter, culminating in the revolutionary year of 1848, when uprisings erupt from Paris to Vienna, after which, they say, comes the reset into a new industrial ordering based on railways and heavy industry. In this telling, the second wave runs from roughly the middle of the 19th century into the 1890s. The new technology clusters here are railroads, steel, the telegraph, and later on electrical power. Globally, you get what historians call the age of capital and empire. Gigantic railway networks in Britain, the United States, Germany, and Russia. Steamships tying continents together, and huge movements of people and investment capital across borders. Again, it is tempting to draw a clean four-act arc. The mid-19th century sees a furious railway and canal boom. Then, from the 1870s to the 1890s, many countries, especially Britain, experience what contemporaries actually called a Great Depression. Not collapsing output, but a very long period of weak prices and profit margins. British price indices show a gentle but persistent deflation through much of these decades, while real wages for industrial workers nonetheless rise as productivity improves. Within that era, you also get major wars. The American Civil War in the 1860s, the Franco-Prussian War in the early 1870s, colonial conflicts on several continents. Advocates of the long wave theory argue that these are not random. In their view, when a maturing industrial system runs into falling prices and squeezed profits, competition between states intensifies. War, in this framing, becomes both a product of economic strain and a brutal way of clearing out old capital and debts. By the late 19th century, the story moves into its third wave. Now the technological icons are electricity, chemicals, the internal combustion engine, and mass production. From the 1890s to, Around 1914, you see a period sometimes called the First Age of Globalization. Trade and capital flows as a share of world output rival or exceed what we saw in the early 21st century. Big corporations, mass consumer brands, and financial markets all expand. On the surface, that looks like another spring and summer phase of a Kondratiev wave, high investment, new industries, optimism. Underneath, though, leverage is building. Countries tie themselves to the gold standard, which anchors currencies but also makes adjustment in crises harder. Rival alliances arm themselves. The shock that follows is as dramatic as any theorist could want. From 1914 to 1918, the First World War blows up that integrated system. Inflation in the United States, which had been relatively contained, surges during the war and in the immediate aftermath. A Bureau of Labor Statistics retrospective notes that from late 1916 to mid-1920, American prices rose by more than 80%, and the single-year increase from June 1919 to June 1920 alone was almost 24%. Then, as the Federal Reserve hiked rates to crush that inflation, prices fell sharply. In the early 1920s, the United States went through one of its deepest deflationary recessions, with the consumer price index dropping by more than 20% between 1920 and 1922. Around the same time, Europe was reeling from war damage, revolution in Russia, and the unstable attempt to rebuild on pre-war foundations. Investors in the 1920s talked themselves into the idea of a new era of permanent prosperity, but underneath that optimism, the monetary and financial order was fragile. When the Great Depression hit after 1929, prices and wages fell outright in many industrial countries. Banks failed, international trade shrank, and unemployment soared. In the language of the Kondratiev story, this is the archetypal winter: deflation, mass unemployment, political extremism. And once again, you see the war and reset sequence. The unresolved tensions of the 1930s feed into the Second World War from 1939 to 1945. Out of that war come two huge monetary and institutional resets. First, Bretton Woods in 1944, which establishes a new global currency system with the United States dollar convertible to gold and other currencies pegged to the dollar, along with new institutions like the International Monetary Fund and the World Bank. Second, the creation or strengthening of global bodies like the United Nations and the General Agreement on Tariffs and Trade that will later become the World Trade Organization. You can see why people who like neat cycles get excited here. A long boom from the late 19th century to 1914. War and inflation. Post-war deflation. Then an even deeper depression and war. Out of that, a redesign of the global economic architecture. From there, the story usually flows into a fourth wave that covers the post-war boom. The technologies this time are mass automobile ownership, highways, petrochemicals, household appliances, aviation, and eventually early electronics and computing. From the late 1940s through the 1960s, many advanced economies experience what the French literally call the 30 glorious years. Sustained growth, rising real wages, expanding welfare states, and relatively low unemployment. Inflation is not a big problem at first. Then in the late 1960s and 1970s, it accelerates sharply, especially after the oil price shocks of 1973 and 1979. In the United States, the federal funds rate rises from single digits in the mid-1970s to an average of more than 16% in 1981, as the Volcker Federal Reserve slams on the brakes to break inflation expectations. Again, long-wave enthusiasts see a familiar pattern. The early decades of the wave are an investment and growth spring and summer. The 1970s are an inflationary, conflict-ridden autumn, with energy crises, stagflation, and a rising sense that the old model is running out of steam. The early 1980s shock then becomes the winter reset, interest rate spikes that crush inflation, bankrupt many weak borrowers, and help pave the way for a different kind of capitalism in the decades that follow. Finally, the fifth wave in this story is the information and communications revolution. Microprocessors, personal computers, the internet, mobile phones, and then cloud computing and smartphones. In many versions, this wave starts somewhere between the early 1980s and the mid-1990s, with the spreading use of computers in business and the mass adoption of the internet around the turn of the millennium. From the mid-1990s to the mid-2000s, the global economy experiences what central bankers called the Great Moderation. Inflation in many advanced economies is low and stable. Interest rates gently fall. Globalization deepens, especially after China joins the World Trade Organization in 2001. Asset prices, especially housing and equities, rise strongly. Once again, leverage quietly builds in the background, especially in housing and in complex financial products. In 2008, the global financial crisis hits. The worst downturn since the Great Depression ripples through the world economy. This time, however, the response is very different from the 1930s. Instead of allowing mass bank failures and outright deflation, central banks slash interest rates towards zero and create new money on a huge scale to buy government and private assets. In long-wave language, some writers argue that this was the first phase of a Kondratiev winter, a financial reset achieved not through global war, but through monetary experimentation and regulatory overhaul. Others argue that it was more like a deep, mid-wave correction and that the true winter is still ahead. And that brings us toward our own time. The years after, the global financial crisis saw a long stretch of ultra-low interest rates, relatively mild inflation, and steady, if unspectacular growth in many countries. Then, in 2020, the pandemic slammed the brakes on everything. Governments and central banks responded with enormous fiscal and monetary stimulus. Supply chains snarled. By 2021 and 2022, inflation had surged to levels not seen in 4 decades in the United States and Europe. Central banks responded this time not with more easing, but with the sharpest collective rate hikes since the early Volcker era. Layer on top of that a war in Ukraine, rising tensions between the United States and China, energy shocks, and talk of deglobalization or friendshoring, and it is very easy to tell a new chapter in the old story. The information age boom has run its course. We have entered a winter of high debt, geopolitical tension, and institutional strain, and some kind of reset lies ahead. That is the narrative version. If you squint the right way, you can carve the last 2 centuries into 4 or 5 neat waves, each with some combination of prosperity, disinflation, war, and institutional redesign. But now we have to do the less glamorous part. We have to ask, does this supposed 50-year heartbeat really show up when you do not know the ending ahead of time? One way to start is by looking at exactly what Kondratiev originally claimed and what later researchers have done with it. Kondratiev himself, writing in the 1920s, thought he saw 3 long cycles in the data up to that point. One from roughly the late 1780s to the 1840s, another from the 1850s to the 1890s, and a third starting in the late 1890s that he believed was still in progress. He focused especially on long swings in price levels and interest rates, with his upswing phases marked by rising prices and relatively low interest rates, and his downswing phases by falling or stable prices and higher real rates. Since then, researchers have tried all kinds of statistical tricks on different data series: price indices, GDP, investment, trade, even patent counts. Some find something wave-like around 50 years. Others do not. For example, a team led by Kondratiev used spectral analysis, a mathematical tool for detecting periodicities on world GDP data from 1870 to 2007. They reported finding a statistically significant cycle in global growth rates with a period of about 52 to 53 years, along with the shorter business cycles that economists already know about. On the other hand, a more recent study using wavelet analysis on long GDP per capita series for countries like the United States, Britain, France, Germany, and Japan concluded that the long wave hypothesis is not well supported by the data. The authors did not see a consistent 50-year periodicity across countries. Instead, they found different long swings of varying lengths and a lot of noise. Mainstream macroeconomists remain skeptical for reasons like these. A summary article on social cycle theories notes that when you use modern econometric techniques, recessions in advanced economies look more like random events driven by shocks than like pieces of a repeating pattern with a fixed period. The appearance of regular long cycles is often better explained as the human tendency to draw smooth curves through a messy history than as evidence of an underlying mechanical rhythm. So, how do we reconcile a narrative that feels so compelling with statistical evidence that is at best mixed? One way is to shift what we think the wave is describing. Instead of imagining a hidden metronome that forces crises and wars to happen on schedule, some historians and development economists treat Kondratiev waves as a loose way of talking about clusters of technological and institutional change. In this view, the big arcs we have been describing are not iron cycles, but overlapping surges of innovation. The spread of steam power, then railways, then electricity and chemicals, then autos and mass production, then information and communications, and perhaps now green energy and artificial intelligence. Each of those surges has a rough life cycle. There is an installation period when the new technology is experimental and speculative. Then there is a deployment period when it gets integrated deeply into production and daily life. That process naturally creates booms, overinvestment, corrections, and institutional rewiring along the way. Researchers like Carlota Perez have argued that many of the financial manias and crashes of the last 2 centuries cluster around the moments when a new technological paradigm is moving from that wild installation phase into a more disciplined deployment phase. In that sense, you do see recurring sequences of boom, disillusionment, and restructuring, but they are not synchronized perfectly to a rigid 50-year pulse, and they do not always produce wars. Another way to test the strong form of the myth is to ask, does this tidy pattern of boom, deflation, war, and reset actually fit each alleged wave when you look at data rather than stories? Take the supposed second wave from the 1850s to the late 1890s. If the 4-phase story were mechanically true, you would expect a clear inflationary boom, then a clear deflationary stagnation, then a big war and a clean monetary reset at the end. What you actually see is more fragmented. Britain's retail price index, which we mentioned earlier, does show mild deflation from the mid-1870s into the 1890s, even as output and trade continue to grow. That lines up with the disinflation chapter, but there is no single system-wide war and reset at the end of that period in the way there is after 1945. You have the Spanish-American War, the Boer War, Russo-Japanese conflict, and imperial rivalries, but no one decisive global realignment. If you shift the endpoints, you can force some fit. Move the turning point closer to 1914, and suddenly you get the First World War and the post-war experiments with gold and paper currencies. Extend the deflationary phase backward from the Great Depression into the late 19th century, and you have a long price downtrend. The problem is that you can only see which dates work after the fact, or consider the 4th wave, the post-war boom. The classic Kondratiev pattern says that upswings should be associated with rising prices and low rates, and downswings with falling prices and high rates. The actual post-war experience in the United States and much of Western Europe is sort of the reverse. The period of strongest growth and mass prosperity from the 1950s into the late 1960s had moderate inflation and relatively stable, manageable interest rates. The truly sharp inflation came later in the 1970s, when growth was already slowing and productivity was struggling in some sectors. When Paul Volcker's Federal Reserve jacked rates into the teens in the early 1980s to break that inflation, prices did fall back towards lower single-digit growth. But the 1980s and 1990s did not feel like a Kondratiev winter. They felt like a new kind of boom in finance, technology, and globalization. So you can make the pattern work, but only by loosening it. The winter becomes less about deflation and more about institutional shifts. The war becomes sometimes a literal world war and sometimes a metaphorical war on inflation or a war on sovereign debt or a wave of political upheaval. At this point, you begin to see the trade-off. The stricter your definition of a Kondratiev wave, the less clearly it appears in the hard data. The more flexibly you allow yourself to redefine the phases, the easier it is to fit anything into them at the cost of predictive power. So where does that leave us in 2025? Instead of asking, are we in Kondratiev winter, yes or no? A more useful question might be, if we step back and look at the last 40 to 60 years as one big arc, what stage of that arc do we seem to be in? Think about the world economy since roughly the late 1970s or early 1980s. We started that era with the Volcker shock, high interest rates, and a determined move away from the high inflation, heavy regulation model of the post-war decades. Through the 1980s and 1990s, many countries deregulated finance, privatized state industries, lowered trade barriers, and embraced global integration. New technologies in computing and communications radically changed how production and services were organized. From around the mid-1980s to the mid-2000s, overall inflation in many advanced economies stayed relatively low and stable. Interest rates drifted down. Long-term Treasury yields in the United States, for example, fell from near double digits in the early 1980s to around 4 to 5% by the early 2000s, and then even lower after the global financial crisis. At the same time, debt levels climbed. Government debt in many countries rose gradually as populations aged and tax cuts persisted. Corporate borrowing increased, especially in sectors that could tap bond markets easily. Housing markets in the United States, Britain, Spain, and elsewhere experienced major booms. Inequality widened as returns to capital and high skills outpaced average wage growth. Then came the global financial crisis in 2008 and 2009. In a stricter Kondratiev framework, that could have marked the definitive end of the long information age boom and the beginning of a drawn-out winter. But instead of allowing a painful but fast debt purge, policymakers chose a different route: interest rates close to zero for many years and large-scale asset purchases by central banks. That prevented another Great Depression, but it also kept leverage in the system and pushed investors further out on the risk spectrum. You can think of the following decade as an extended, somewhat artificial late autumn. Growth was okay, but not spectacular. Inflation was low. Asset prices slowly inflated under the pressure of cheap money. The underlying technological wave of digitalization kept rolling, but social and political strains accumulated. Then the pandemic hit in 2020, followed by unprecedented fiscal support and supply disruptions. During 2021 and 2022, inflation reappeared in a way many younger workers and investors had never seen in their lifetimes. In response, central banks embarked on the fastest global rate hiking campaign since the early 1980s. The average federal funds rate in the United States jumped from effectively zero in 2021 to over 5% by 2023 before easing somewhat in 2025. Housing affordability became a serious issue in many cities. Wage growth for many workers initially lagged inflation, then began to catch up. By 2025, reports from organizations like the OECD and various news outlets pointed out that real wages in the United States had begun to rise again after the worst of the inflation surge, but remained under pressure in parts of Europe and Japan. Overlay that economic story with geopolitics. The relatively unipolar world of the 1990s and 2000s, with the United States as undisputed hegemon, has given way to a more contested landscape. Tensions between the United States and China over technology, trade, and security have escalated. Russia's invasion of Ukraine in 2022 shattered assumptions about European security. Supply chains, especially in critical areas like semiconductors and green technologies, are being reorganized along political as well as economic lines. Whether or not you believe in Kondratiev waves, it is hard to avoid the feeling that the institutional and geopolitical order that crystallized from the late 1970s through the early 2000s is under strain. So, If you put on a cautious long-wave lens for a moment, where might 2025 sit? One reasonable, very tentative way to describe it is this: we are somewhere in the late stage of a long cycle that began with the information technology and globalization surge of the late 20th century, and that is now colliding with its own side effects. High debt, inequality, demographic aging in many rich countries, climate pressures, and strategic rivalry. That does not mean a scripted collapse on a precise calendar date. But historical patterns suggest that periods like this often involve a few overlapping features. First, the existing monetary and financial regime tends to get stress tested. In the 1970s, that stress came from trying to maintain the Bretton Woods dollar-gold link in the face of US inflation and imbalances. Today, the stress is about sustaining high public and private debt loads in an environment where inflation risk has reappeared and interest rates cannot stay near zero forever without consequences. Second, there is usually a rotation in what drives growth. Just as railways eventually gave way to autos and highways, and post-war consumer durables gave way to information and communications, we are likely in the early phases of another rotation. Candidates include decarbonisation technologies, biotechnology, artificial intelligence, and new forms of manufacturing and energy storage. We are still in the messy installation phase of many of these, where narratives are ahead of profits and policy frameworks are incomplete. Third, the rules of the global game tend to get renegotiated. Past resets have included formal conferences like Bretton Woods, but also slower processes like the move from fixed to floating exchange rates in the 1970s, or the post-Cold War expansion of world trade rules. Today's version might involve new arrangements around digital currencies, cross-border data flows, climate clubs, and regional trade blocs. From a Kondratiev perspective, that combination of structural strain plus emerging technologies looks a lot like the late autumn to early winter transition of a long wave. Not cheerful, but also not unprecedented. Crucially, though, history also shows that this kind of period can play out in very different ways. The transition from the late 19th century global order to the mid-20th century involved 2 world wars and a Great Depression. The transition from the inflationary 70s to the information age boom of the 90s, by contrast, involved recessions, financial stress in some regions, and painful adjustments for some sectors, but nothing remotely on the scale of the 1930s. Which path the 2020s follow depends on choices, not on a cosmic schedule. So what does any of this mean for you as an individual trying to navigate your career and your finances? There are a few practical ways to use this long cycle thinking without turning it into superstition. The first is psychological. When you realize that the environment you were trained for and grew up in is not permanent, you stop taking its rules for granted. If you entered the workforce in the 1990s or 2000s, you internalized an era of disinflation, falling or low interest rates, and steadily deepening globalization. Safe assets like government bonds tended to do well as yields fell. Consumers could refinance mortgages at lower rates again and again. Corporations could roll debt easily. Real wages in some countries stagnated, but goods kept getting cheaper. If you are younger, you grew up entirely in that cheap money, low inflation world, with the exception of the 2021 and 2022 shock. The mental model that many people developed was simple. Markets usually recover quickly, central banks step in aggressively during crises, and the big risk is missing upside rather than protecting against downside. Long cycle awareness is a reminder that regimes change. The United States has already moved from 4 decades of mostly falling interest rates to a world where the average policy rate in 2023 and 2024 is higher than at any point since before the global financial crisis. Fiscal constraints in many countries are tighter. Demographic aging is changing labour markets. That does not mean permanent crisis, but it does mean the next 20 years are unlikely to look exactly like the previous 20. Translated into career terms, that suggests valuing adaptability over trying to surf one specific narrow boom. When technological and institutional paradigm shift, the safest positions tend to be those that ride the big currents rather than the little ripples. Historically, waves of innovation have created outsized opportunities for people who learn new skills early in an emerging general-purpose technology. Steam and mechanical engineering in the 19th century, electrical and chemical engineering in the early 20th, software and networking in the late 20th. Today, artificial intelligence, data science, robotics, green energy systems, and disciplines that mix technical and human skills such as product management, health technology, and climate risk analysis are candidates for that sort of leverage. At the same time, long transitions also tend to increase the value of resilience. Public sectors, healthcare, education, and essential services often see more stable demand even when financial markets are volatile. People who combine domain expertise in these areas with literacy in data and technology can become very hard to replace. For your financial life, long cycle thinking is less about predicting whether 2027 is a crash year and more about preparing for a world where volatility is not an anomaly. If we are in a late cycle environment with higher average interest rates than the 2010s, some broad implications follow. Cash and short-term safe instruments are no longer guaranteed to lose purchasing power to inflation every year. In the near-zero rate world after 2008, holding significant cash was heavily penalized. In a world where treasury bills or insured savings accounts pay non-trivial nominal returns, holding a buffer of safe, liquid assets becomes less costly. That, in turn, gives you options when markets or job conditions become rough. Equity markets in past long transitions have tended to deliver positive real returns over a decade or two, but with deep drawdowns along the way. In the 1970s, for example, US stocks went through brutal bear markets even though cumulative nominal returns over the decade were not terrible. The lesson many investors and historians draw is that diversification across asset classes, regions, and sectors is especially important when macro conditions are shifting. Real assets such as housing and land have historically provided both shelter from inflation and exposure to credit cycles. In some Kondratiev narratives, real estate is central to the late boom and bust dynamic as cheap credit flows into property and then reverses. Recognizing this does not tell you when housing will peak in your city, but it does underline the importance of not stretching your personal finances to the absolute maximum just because credit is available. Another area where long cycle thinking helps is expectations about government safety nets and policy responses. In early phases of a long wave, such as the post-war boom, it is relatively easy for governments to expand welfare states and public services. Growth is strong, interest costs are manageable, and demographics are favourable. In late phases, with slower growth, higher debt, and ageing populations, policymakers have to make harder trade-offs. The experience of many advanced economies since the global financial crisis has been that large, permanent expansions of public support become politically contested. That does not mean there will be no support in future crises. The 2020 pandemic response showed that governments can still mobilize huge resources when they decide to. It does mean that relying entirely on future policy to backstop your personal risks is more fragile than building your own buffers where you can. If you think in terms of historical patterns, one possibility for the next decade is a kind of tug-of-war between the need to stabilize debt dynamics and the temptation to smooth every shock with fiscal and monetary tools. That tension can create cycles of tightening and easing rather than a smooth glide path. For an individual, the response is less about trying to front-run central banks and more about ensuring that your own budget can survive those swings. There is also a political dimension. Previous long transitions, especially those that squeezed the middle class and produced high inequality, have often seen a rise in populist movements and more turbulent politics that can translate into swings in regulation, taxation, and trade policy that affect specific industries heavily. If you work in sectors that are particularly politically exposed, such as fossil fuels, big tech platforms, finance, or cross-border manufacturing, building flexibility into your plans becomes more important. That might mean investing extra in generalizable skills, cultivating professional networks that cross sectors, or being willing to move geography if opportunities shift. So, stepping back, how should we summarize where 2025 sits on the so-called 50-year supercycle? Here is a balanced way to put it. First, the strong version of the Kondratiev myth, where the world economy obeys an almost mechanical 40 to 60-year wave with a fixed sequence of prosperity, deflation, war, and reset, is not supported by the data in a way that would satisfy most statisticians. Some studies do find evidence of long swings around 50 years in global GDP or prices. Others do not, or find different periods. There are simply not enough full cycles in the industrial era to make this more than an intriguing pattern. Second, the weaker version, which treats Kondratiev waves as a storytelling framework for sequences of technological surges, financial booms and busts, and institutional change, does line up reasonably well with many episodes of the last 2 centuries. There really was a cluster of upheavals around the transition from the 19th century order to the mid-20th century one. There really was a dramatic shift in monetary and regulatory regimes around the late 1970s and 80s. There really does seem to be a new cluster of technologies emerging now that will reshape production and everyday life. Third, if you place the current moment on that looser map, 2025 looks less like the calm middle of a tranquil wave and more like a choppy zone near a turning point. Interest rates have risen sharply from the ultra-low baseline of the 2010s. Inflation, after an initial spike, has moderated but not disappeared. Real wages in many countries are still trying to regain lost ground. Public and private debt loads are high. Geopolitical tensions are elevated. The institutional architecture of globalization is under review. That does not imply imminent doom. It does imply that historical patterns suggest more variability ahead than many people grew up expecting. For ordinary people, the most constructive way to respond is not to obsess over whether the Kondratiev winter label is exactly right, but to acknowledge that we are living through a regime shift and to act accordingly. Build skills that are useful in multiple technologies and industries, especially those tied to likely growth areas such as digital systems, green energy, healthcare, and advanced manufacturing. Keep your personal finances conservative enough that you are not forced into desperate decisions if the economy hits a rough patch. Stay curious about how policy and technology are evolving, not to time the market, but to recognize when old assumptions about jobs, inflation, and interest rates have quietly changed. And perhaps most importantly, remember that even the harshest historical winters eventually gave way to new springs. The story of the last 200 years is not one of endless decline or endless boom, but of waves of challenge and adaptation. People have built careers, families, and fortunes in every part of those cycles, including the messy transitions. Understanding the long arc can protect you from the illusion that today's conditions are permanent, but it should not paralyze you into inaction. If you found this deep dive into the 50-year supercycle helpful, if it changed the way you see the economic headlines around you, take a moment to hit like, share this video with someone who is trying to make sense of the bigger picture, and subscribe to the channel. We will keep unpacking the stories and the data behind the economy you are living in, so you can navigate the next wave with your eyes open.